Hello everybody, it has been a very long time, I think 2 months since I updated this channel. Why? Because it has been extremely boring. It has just been all about rate hikes, rate cuts, and the markets pushing out expectations of the first rate cut and the terminal rate. Inflation has been cooling, hottening, reaccelerating, and the core is lowering, higher, and Jay Powell is comfortable, and then he's not comfortable, and then he's dovish, and then all of a sudden he's hawkish. It's just been extremely idiotic. So I'm just focusing on the result announcements nowadays and not talking about something more. So this is MIT Maple Tree Industrial Trust full year 23 results, and overall I think it's still a very steady chip. I use the word chip because I think it actually is somewhat of a proxy against the growing AI craze and the demand for data centers in the US and all over the world. Especially you think about it, right? Now it's almost like a in Chinese we say 八国联军. A lot of the Western countries and some of the Northern Asian countries all just ganging up and trying to contain the rise of China. So the data center boom and the AI is not just benefiting the US but also the North Asian partners of Japan and Korea, and also maybe some parts of ASEAN, especially Malaysia, in particular Penang, and maybe even Singapore. And I think MIT has a very good footprint in Singapore, US, and recently in Japan. So I think it's actually a pretty decent play on data centers and the rise of data and stuff. The most important thing is of course rate hike lah. I mean, we're talking about rate hike for the past 2 years. It's almost like I'm almost fed up talking about it actually. But now we are pushing out the especially with yesterday's inflation print of the core PCE. I think expectations of the first cut has been moved all the way down to December. In fact, personally, I think there's no cut for this year at all. Because there's no way the Fed can cut in June anymore with the hot inflation print, especially for the core PCE. And subsequently, we go into November, December period, October, November period with the US elections. And there's no way in living hell the central bank can lower rates because that would be like a prejudice towards any presidential candidate. So the Fed will not do that. So that leaves the door open for maybe December. And I don't see that happening as well. So I think for me personally, I think there's no cut this year. There's no cut this year, and the market expectations is one cut in this year, and then like by September 25th next year, they're expecting something like 1% in total. I think maybe there'll be a cut in maybe March next year, and maybe like a couple more. So I don't know, but the rate cut expectations have dramatically been pushed out. I have been suffering as well. My REITs portfolio is down 10% for this year, so giving out maybe like 80%, 75% of the gains last year. The good thing is that I sold quite a bunch of stuff, especially iREIT. I was especially happy about selling that out, and ESR. Happy about the decision to rotate into UOB. Unfortunately, I also bought a whole bunch of stuff using the dividends. I bought a Capital Land, which has collapsed as well. That was rather stupid. But I bought a bunch of stuff in Hong Kong, and some stuff in Singapore. No REITs though. I don't intend to reinvest my dividends into REITs because already it's at 48% of my portfolio. So I don't really want to increase that anymore. I'll just be sitting back and collecting dividends and see how it goes. Overall, I think it has been just U.S. fiscal recklessness causing all these problems. You can see that the inflation rate for a lot of other countries are just slowing. In Singapore, our core inflation rate is down to like 2.7%, lower than expectations. Whereas in the U.S., the core PCE is still way elevated. I think there's a contradiction between fiscal and monetary. So the Fed is tightening, but yet Biden and his administration is just pouring stimulus after stimulus, issuing debt after debt, and expanding the fiscal deficits again and again. And it looks like a impossible game to solve of the rising debt loads on the U.S. Treasury, and whether or not they can actually pay back the debt, especially with interest rates at 5% in the short term. And it's just a complete contradiction and complete disaster, I think. But nonetheless, nobody cares, which is really bizarre. Actually, things are happening, which I'll talk about later. But look at the recent numbers released. GDP is weaker than expected. But I think people are expecting this number to jump. So I don't think people care about this number. It is this number though that is of concern, especially the core PCE. 2% prior expectation is 3.4 and came in at 3.7. So core PCE is still increasing. Why? Because the Biden administration is still doing stimulus. It's ridiculous, and you can see what's happening, right? China is reducing its U.S. Treasury Holdings now 800 billion, down from the 1.3 trillion in a decade ago. So that's almost a halving, right? So without a significant buyer of the U.S. Treasuries, especially in the long-term rates in the U.S. will rise, causing even more problems. And you can see also very, very significantly the movement of gold. You can see, boom, people are just diversifying from the U.S. Treasuries into gold, especially China, and I won't be surprised if it's also Russia and maybe Iran and I don't know a bunch of other people. I think in Singapore the MES is also doing the same thing. The U.S. situation I think is really a disaster in the making, but yet nobody cares in the U.S. That's the failure of the Congress, dude. So let's go back to then the MIT's numbers for this year. I think the fourth quarter numbers were actually better than I expected. DPU for the fourth quarter was 3.36, and it seems to be a very, very clean quarter. So you can see that the last numbers has all these asterisks on top, and they were like all capital top up, right? You can see over here top ups to second quarter to third quarter, and so on and so forth. So this quarter seems to be clean, a clean DPU. Which is nice to know. So overall year on year is just a 1% dip, which is really, really pretty nice. Which was what I talked about previously actually. I think like the past few quarters I've been talking about the results, and I think the numbers are still gonna be pretty steady going forward. Because I think for interest rates will still go higher and financing costs will still rise, but they have nonetheless continued to divest the assets in Singapore. Now the Tanglin Halt cluster, and I think there'll be some capital gains, and then they can distribute the stuff as capital top-ups to arrest the decline in DPU stemming from the rise in finance costs. So I do expect all this stuff to continue. As to what extent the DPU will decline is really a function of how much capital top-ups they can afford to release. So these are the key highlights. The MPI, DPU, whatever, it's all kind of expected actually. It's quite nice to see though that there are positive rental reversions across all segments of the properties, be it Singapore and North America. So all the rents are rising, and so on and so forth here. I'm quite surprised actually. They could issue 15 million of debt of paper for 3 years at 3.75%. I would have expected the interest rates to go up to like funding costs to go above 4% already. So I think the credit name for this guy is still decent at 3.75%. So hedging out 85% of the debt with an average tenure of 4 years, an average of 38%. I think it's comfortable. But nonetheless, though, with the paper issued at 3.8% and current funding at 3.1, I do expect the overall funding cost for the next year to rise, maybe around to 3.4 to 3.5%. To the extent that impacts DPU is again, like I said, a function of whether or not they utilize some of the divestment proceeds to top up DPU. I do expect some of that to come in, but I do expect maybe another like 2-3% drop in the DPU. Nonetheless, it's still pretty attractive. I think the ICR is also very comfortable, 4+ times. It's not going to collapse to 2 anytime soon. This is the debt maturity profile. I can see with the issue of the 3-year paper, it's been wrote all the way to here. So this is going to be a decent segment, chunk over here, a pillar to finance. Nonetheless, this chunk here is still pretty sizable at 20%. So overall, when rates continue to stay high through here and through here, unfortunately, DPU will continue to fall. Another thing to look for though is the issuance of the PERP, which will reset in May 26. So with the reset rate at 5 years SOR plus spread of 2%, you're probably looking at the 5+%, 5.5% reset rate versus a 3.15% reopen coupon. So probably gonna be a 2.5% jump once they refi this stuff. I don't think there's any headroom for them to reissue to issue more debt to call this fella, because the funding is already at the gearing is already at 38%. So I think it's probably gonna be just a non-call and just let it reset. Unfortunately, I think that's gonna happen. It's gonna happen over here. Alright, so this is the NAV unfortunately has fallen as well. Would you expect again Singapore properties continue to be steady ship, but the stuff in the US are falling because of higher cap rates? Overall, I think it's been a disappointing quarter for me actually. I was expecting much higher. No, I was expecting a lower DPU. So the DPU was a bit for me, but I was expecting a lot more activity to happen, which made it an overall disappointing quarter for me. I expected the Kallang Way property, which TOP'd last year, to lease faster, but I think it's now just 50+% or 60%. I would have expected actually that by now they lease out 80%. So I think the leasing progress for the Kallang Way property was below my expectations. I thought the DC data center replacement tenants for AT&T's leaving was low. I think talks are still ongoing. I would have expected a faster rate of replacement actually. So I think the over here is a bit of a concern. So if no replacement is found, my projections is for another 1% drop in the DPU. Because of the departure of this key tenant. I was also very disappointed. There's no major announcement of the rejigging of the portfolio to re so I was expecting for this year for them to sell like maybe $500 million of assets and then redeploy the capital into data centers in Japan for a still positive yield spread over there. And if they can do that, actually, they release more capital that can be used to top up DPU to arrest the decline due to rising finance costs, and yet they can then deploy the capital into Japan and still do some stuff to capture the positive yield spreads and perhaps issue long-term yen paper to lock in the low rates as of now, because you never know when BOJ will raise rates in the future. So while rates are still low in Japan, might as well just do it now and issue longer term paper and capture in lock in the positive yield spread. So I think the lack of progress, a more significant progress towards the rejigging is a disappointment. They did divest Tanglin, but well, I expect a lot more actually. So overall, MIT still occupies 7% of my portfolio. I'm not selling the MIT. I think it's a fantastic REIT. Well managed, capital structure is strong. I'm happy to collect the dividends, and I'm gonna collect 2.3 cents more in coming few months. That will lower down my average cost again. And then another 2.3 cents again. So I'll keep it actually for my portfolio, but it's just that I'm not gonna reinvest the dividends into REITs again. So this is the end of this summary for MIT. There'll be a few more summaries coming up. Just for some of the key REITs that I hold and their earnings, especially that for Star Hill Global and some of the other REITs as well. So look out for it. Alright, enjoy your day.